Whether you're buying your first house or maybe your 10th house, mortgage lending is rife with questions. In this interview, I talked to Janet Widmer, a 30-year lender with CMG Financial, about the things that lenders wish you knew before you went for approval for a loan to buy a home, or maybe some things you need to understand better before you get qualified for lending in your home. We also talk about changes in the market in the last couple of years, not just interest rates, but the tremendous increase in values and how that's impacted metrics that lenders look at as they qualify and approve people for loans. And then maybe we get into a couple of small things that you didn't know about lending. USDA, what is it? How do you qualify? All that and more in this interview. Enjoy. I am with Janet Widmer, Senior Loan Officer at CMG Financial. Your office is in Burnet, but you serve all of Central Texas. And do you go beyond Central Texas?
Yes, the whole state of Texas.
The whole state of Texas?
The whole state of Texas and Louisiana.
Into Louisiana as well. Wow. That's a big coverage area.
Yes.
Well, she's really great at it. You've been doing this nearly 30 years, I think you told me one time.
That's right. 30 years in July. This July will be 30 years.
Wow. And I bet you've seen a lot of changes. Over that time, this is my opening question, by the way. Over that time, I bet there are a lot of things that you wish you were able to tell borrowers or buyers that would get them better prepared, not only for the process, but help you be more responsive to their needs and help anticipate their needs. What are some of those things, Janet?
That's a great question. Well, the very first thing that I would say is it starts with that initial application. Being as open and honest as you possibly can with that application. Sometimes I feel like even though we're all automated and I send my link to people to fill out the application, that's only just the first step of it. So then as soon as that's done, then I immediately call them, and that's when I get to the nuts and bolts of everything. Making sure that nothing's held back. An example, a borrower that may have jumped jobs a couple of times, that's a couple of months, they feel like they can leave that out. Well, during the process, we're going to find it out. We're going to find out every place they've worked and everything about them. And so if it hadn't been disclosed up front, then it starts to make you question things, and it makes puts a chunk in the process. So I think being as open and honest and understanding, a traditional mortgage loan is a conventional loan with 20% down, 30-year fixed. That being said, everything's a hybrid, if you would, off that. And so there's so many loans that are available. And so the more accurate we get that application, the more things we can open up. There are 3% loans available for people. And you don't even have to be a first-time home buyer for that. There are multitudes of different loans, and then once again it goes all the way back to that application. So I think that's the most important thing, is being open and honest and just laying it all out. A lot of people don't realize too, education works towards that 2 years. On all loan applications, we're looking for 2 years of everything. 2 years job history, 2 years residency, 2 years, 2 years. And so if someone's fresh out of college, that college acts as previous employment for the 2 years.
Oh, wow.
Yes, and so the next thing is, I think more than anything else is, I call it the peanut butter and jelly time. So cash is king. Even if we can find a program, like I do a lot of loans for Texas State Affordable Housing, down payment assistance. And so running a loan through an automated system, having reserves, cash in the bank, makes all the difference in the world in an approval. Sometimes I'll play with the loan. A borrower has $2,000 in their bank account. The majority of their income is coming from either seller pay, closing costs, or down payment assistance. And I just can't get the automated approval that we're looking for. So I'll play with it. I'll create like a little account, and I'll label it cash short to close, and I might put $1,000 in there, and sometimes I can get my approval out. So a lot of people say it's just really hard to save money, and yes, it is, to purchase a home. But part of what we do is we go back and think, let's look at that bank statement you just sent me. Let's see how many times we're going out to eat every week, and those kind of things. And so that's why I tell my clients, and I mean it, I do it myself. Let's go to peanut butter and jelly time. If you don't have to, don't. Save as much money as you can.
It sounds like some part of it is financial counseling, not in an official capacity by any means, but regardless of whether you're a first-time home buyer or, like we talked about earlier, a 50th time home buyer, having an understanding of your own finances and your own financial habits and your financial positions is really important as you enter into the home buying process or the borrowing process. And I don't know, I would lean into you on this, I don't know that we collectively have a firm understanding of how our finances work, how the income goes to the outflow and where your money goes every month. If you've got a better feel for that, specifically if you can track it through budgets and transactions and things like that, it probably helps them understand how they're better qualified to borrow. Because I know, at least with you and clients that I've had that have worked with you and with others, just because you qualify for it doesn't mean you should borrow it.
That's right.
It may put you in a position that doesn't allow you to do the other things that are required of you financially, even if you're approved. That's
exactly right. You know, pushing the limits of that debt ratio is what you're talking about. You know, there's a front end ratio, and that's the percentage of your new mortgage payment, including taxes and insurance and HOA and all of that, in relation to your gross income. And then there's the back end ratio, which is all of that new mortgage plus any additional debt you have. After the big fiasco in 2008 and that, you know, when anybody could buy, anybody could, you know, there was just no limits. They put limits in place, and I feel real comfortable and I'm glad that they didn't expand those. Those haven't been expanded lately when the prices have gone up and interest rates have gone up. They haven't expanded those ratios, and that's very good. Because just like you just said, just because you can doesn't mean you should. If I have a borrower that I'm pushing to the limit, debt ratio 56% on an FHA loan, but the wife's not on it. And I know, I've seen her income. For whatever reason, she's not on it. Maybe she's had a little bit of credit issues in the past. Maybe she can't validate her income as much because she's self-employed. But I've seen it. I know there's an additional amount of money going to that household. I don't mind at all pushing those ratios. But with somebody who can barely make ends meet, that's just not a good thing for them. And I think that it's helped me over the years. By not doing that long, by counseling them to do that.
Do you and other lenders probably have tools to help people budget documents perhaps, or just a way to lay out their finances in a way that maybe they haven't, and maybe a tool for tracking cash flow so they have a better understanding of their real financial health versus just looking at, well, I make this much money, I should be able to buy a house. It doesn't work that way.
That's exactly right.
And you do have those tools.
I do have. I have 3 different, one of them that I really like a lot. And, you know, I'm old school. So it's still, let's get your number 2 pencil and look at this out. And so I am not a counselor, and I'm not a financial advisor. But I do give them these budgets and say, you know, let's look at your bank statement together. You know, if you're going out to eat 8 times a week, that's a problem. That's something that needs to be under control. And just showing them, because like you just said, showing it in black and white to somebody really makes an awakening to them. You know, so instead of going to a burger place for lunch every day, pack a peanut butter jelly sandwich.
That's good.
It really, I mean, I have repeat buyers that'll refer their kids to me, and I go, put them on a peanut butter and jelly plan, because it works.
It does. Well, and we'll put your contact information in the description, because knowing you the way I know you, they're not obligated to become your client to have access to some of these tools. If it helps them become more educated buyers at a future time, you're happy to share that information. And it ultimately is beneficial for everybody, regardless of whether you're buying a house or not, to know how your money is being spent. And to know it on black and white, as you said. That's a really good segue, too. You'd mentioned earlier about values. We've talked a lot about interest rates in the public discourse a lot in the last year and a half, as interest rates have gone up pretty significantly compared to where they were at historic lows. One of the things that doesn't get discussed enough from my perspective as a real estate professional and probably from your perspective as a borrower or a lender rather, is how much values have gone up relative to people's income. So for example, where we're at in Central Texas, conservatively in a lot of these places, values went up 40% in 2 years. Some areas more, some areas moderately less. People's incomes did not go up that much. And I'm certain that it's impacted the number of prospective buyers for sure when you compound that with rising interest rates and the monthly outflow that may cause. But has it impacted the lending environment from a metrics perspective? You mentioned debt to income ratios earlier, how they really haven't changed much. Well, that just means there's going to be fewer qualified buyers.
That's right.
That's okay. But it also gives somebody a target that maybe doesn't qualify today to aim for that. Have other metrics changed though? Debt to income ratio, or is there a target percentage of net income that a mortgage payment should go to from your perspective? Or are there some different metrics that have changed since values have gone up, or are things still kind of in flux?
I think they're still like 28 over 43. That is the average across the board. That means 28% of your gross income should be your mortgage payment.
No more.
No more.
That's max.
That's the guidelines say. And 43% to be your new mortgage plus any of your other debt. That being said, when you have good credit, you can have expanded ratios. Good credit and cash is king. So like on an FHA loan, for example, we can go up to a 56% back-end ratio. 56% of someone's gross income. And that's when it gets kind of, to me, after seeing so many problems with when you push the envelope, I don't ever want to go back and see people flounder and lose homes and stuff like it did back in 2008, 2009. I was fortunate, I never was part of that subprime business, but I saw it hurt a lot of people. I know this is going to sound crazy to you, but keeping up with the Joneses is not always something we need to do.
No.
When these prices started going up, I had people tell me, I'm going to put my house on the market. Realtors were knocking on my door, literally telling me how much they could sell my house for. And so I put on market on buy something else. Well, and you're really excited about that, and that's wonderful. You're going to get $50,000 more than you think you're going to get for your house. Then you got to buy a new one.
Yeah, if you've got no place to go, don't do it.
That's
yeah.
right.
Yeah.
That's right. So that was the biggest thing. And then I saw like a tightening. Like in some of the renovation loans, that's not the same anymore. But at first, like renovation loans, which is something I love to do, find a home that's good structure, good meat and bones, and do a construction loan, a rehabilitation loan. And I love that. I love everything about that. Finding good properties with good mature trees and all this, kind of thing. How do I say that? When COVID first hit and everything was going, nobody really knew what to do. They were pulling back the strings of it. So the renovation no longer could go for second homes and investments. It could only be for owner-occupied properties. And so it was on that edge. And so even though the ratios on the other side, getting automated approval for some of these loans was tightened up. It's like they just turned the tightening up on it. The day before yesterday, we got an internal email that says now there are none of the additional restrictions on lower credit scores. So we're opening up. They're not expanding the ratios, but for example, if you're doing an FHA loan, we could go as low as a 580. But if you have from a 580 all the way up to a 619 credit score, there were a lot of additional restrictions. For example, you couldn't go to 56%. You could go to 45%, and you have to have a certain amount of reserves in the bank. That's been taken away now. So some of the things are loosening up in the market, but I haven't seen the expanded, limitless, if that makes sense.
Yeah, it does. Well, and there are things that change over time too, relative to value. For example, I know FHA floor is now 472 or some 472,000, something like that. And then there's other components to that that'll take it into the $724,000 range. VA loan, I think you were telling me before we started recording, with no money down, up to $1.2 million. But they have to be qualified borrowers and things like that. There are other products out there, and this one's kind of self-serving because I don't know a lot about it. I know a little about it, but I also rely on people like you that are experts at this. It's a relatively new product relative to FHA and VA, and it's the USDA loan. I would love to know more about what that is, how it's differentiated from the other lending packages that you and other lenders can extend to people, and how does somebody know they qualify for it, or the property they're trying to purchase might qualify for it?
That's a good question. So USDA is exactly what it sounds like, United States Department of Agriculture. And the purpose of it was to help folks out in rural communities to be able to get into a home, and it's 100% financing. It has very low, it has a finance mortgage insurance premium of only 1% of the loan amount that's financed in. And then it has a monthly of a 0.30%. So it's very low, very good. And on a USDA, as long as the price value is there, you can roll in a lot of the closing costs. So it's really good. The idea behind it is cities, towns of 20,000 or less.
Okay.
Now, that's out. That's for the city proper, but then there's also out in the county. The areas that have rapid growth, like take Liberty Hill, for example. For a long time, up until, I guess, maybe 3 or 4 years ago, everything in Liberty Hill, you could do USDA funds. You can't do that now. In the areas of rapid growth, they recert those every 3 years now. They look at it. They look and see how fast is this growing. Is it still going to qualify? Because they don't want it to be used for everybody. They want it to be used to build up the rural communities, for example. So they have income guidelines on it. There's also a little, we have a site that we go to, and you can actually punch in the address. And I wanted to tell you that. I punched in, I picked up an address, just one that I saw in Vernon. I punched it in, and it comes up and it tells you that yes, this property is approved. And then it has a place where you can go in and punch in the income. It counts all income, even if somebody's not on a loan. So let's say that you and your wife are buying a house, and she doesn't have an income, but you do, because we have that. But your mother-in-law moved in. Mother-in-law's not on the loan. She's not on the deed or anything. But she has Social Security coming in. You have to count that. And so it gives you a little graph, and you punch in, it'll tell you if the property's eligible. It says, too, that it's up to the same conforming limits. I don't know how you can have conforming limits for $726,200. So when you're limited on your income, I don't know how a USDA would ever go that high, but that's how they have it.